Well, let's get more on this space. Joining us now is Tim Evans from Longleaf Trading Group. He joins us live from the CME in Chicago. Tim, great to have you with us this morning. Let's just talk energy within the broader market, because we have in fact seen it somewhat weaker today, tracking ExxonMobil lower also. What's your take here?
Well, I mean, I think overnight, I mean, the U.S. dollar getting off to, a pretty good start. Obviously that's going to be bearish for dollar-denominated assets, especially crude oil. I remember the big supply glut is inside the United States, and that needs to get exported out of the United States to help find overall balance in the market. And the U.S. dollar continuing to move higher makes that product more expensive for foreigners to buy. So that definitely has a negative impact. But I don't think what we're seeing, I think more than anything is we're looking at seasonals. I mean, the fourth quarter is typically the weakest quarter of the year for crude oil. I mean, over the past 25 years, crude oil has averaged a negative 7.5% return, over each fourth quarter. There's a lot of seasonal factors in play. I mean, refineries go into maintenance. That reduces demand for feedstock crude oil. Demand for refined products like gasoline, demand for those products typically fall off after driving season, but then ramp back up during holiday season. And demand for distillates like heating oil and diesel, demand for those products really don't pick up until the latter half of the fourth quarter, when temperatures drop and those products are needed. So I think it's just more or less a bad calendar set up for crude oil right now. I'm not reading too much into the downside today.
With that in mind, let's talk broader price action then, and your forecast. WTI posting its strongest quarterly gain since Q2 of 2016. With that in mind, and perhaps the scene set, as you've mentioned, from here with the US dollar index, what sort of price points are you looking to when it comes to WTI?
Well, WTI, I mean, I think the rally that we saw was expected. As soon as we, rally up to, $53 roughly, I don't think it's any coincidence Baker Hughes announces, an increase in rigs by 6, which stopped or halted a slide that we've seen, over the last month and a half. So I think more or less we're going to see good balance in the market. I mean, I think the data is very clear. At this point, I think there's general consensus on the fact, while this has been slow, this production cut agreement is in fact helping clean up the market. It's just doing it at a very slow pace. So I mean, I think that provides a floor in the market. Really, I don't see much below 50. I don't see much above 55. So I think we should probably be staying trapped within those ranges, at least until the end of the year.
Certainly. And then, of course, our attention looks to what 2018 will look like. Tim Evans, we'll have to leave it there. Great to have you with us this morning. Thank you.
Thank you so much.